Any shares that you hold in an ISA, those are also capital gains tax free. Another very commonly held asset, I think a lot of us will be holding this, and it's capital gains tax free, is if you own your own house and you sell that house to someone, any profit you make on the sale of that house should be free of any capital gains tax.
These are my favorite type of podcasts because this is like a glimpse into your former life.
If you make a loss on an asset, you can claim that loss. So pretty sneaky, but that's what they do.
I remember when I first found out about how capital gains was taxed. Then I looked at my debt repayments and everything like that, and I was just in a blind panic. And then I was just thinking, how am I going to buy a house?
There is that disparity, isn't there, between what you pay on a capital gain versus what you pay on income tax.
If you don't understand the taxes that you pay, the chances are you are going to pay too much. And the tax that we're going to talk about today, I don't think we've ever really done a dedicated podcast on about, mate. We might have mentioned it in passing.
Yeah, no, I think this is totally new. So we definitely mentioned it here and there when things have changed in the budget and so on, although not huge amounts change normally with this tax. But yeah, I think this is the first time.
Okay, cool. And we are talking about capital gains tax. So we're going to tell you about how capital gains tax works. We're going to talk about some important exemptions that can apply. And also we're going to talk a bit about the differential rate of capital gains versus, well, capital gains are taxed differently to income. So I'm going to learn a bit in this podcast as well. So looking forward to getting into it. Back on the pod after what seems like a really long break. It probably doesn't seem like a long break to listeners, but we haven't done a pod together for a little while because we usually take the summer off, even though the pod doesn't stop.
Yes, I think the last one might have been inheritance tax, maybe. So either way,
it's going to be a tax.
It's going to be tax. Yeah, that's my main focus. And if I come on the podcast, isn't it really taxes or updates or budgets? Sometimes questions and answers. We sometimes do those as well. But yeah, tax is my main thing.
Yeah, awesome. So other thing to say is, I don't know how this happened because this podcast genuinely did start in my garage with only one microphone. And we've left those episodes up there. Episode 1 is still available. I haven't listened to it. I imagine it's pretty cringy. But we're approaching 1 million downloads, which is amazing. And we're really grateful to everyone that has shared this podcast, found it useful, given us feedback, left us a review, hit the subscribe button, and more importantly, told your colleagues about it. But we are approaching 1 million downloads. And I was kind of thinking like we should maybe do something to celebrate 1 million downloads.
Yeah, I think it's an amazing milestone. And thank you to everyone who's downloaded the podcast and listened to it and given us feedback and so on. It's been phenomenal how it's grown from those cold days in your very cold garage. And yeah, likewise, I wouldn't want to listen back to the first podcast. I imagine it would be very cringy. But yeah, I think it'd be very nice to do something for that.
Yeah, so if you're listening on YouTube, drop in the comments what you think we could do. I was thinking about this. So we could do like our favorite episodes and why. So that'd be one episode option. Someone could interview us and, I don't know, talk about like how the podcast started and stuff, because a lot of our listeners won't be aware that we really did start in a garage. I think we had 10 downloads in our first month. And at the moment we're at about 40 to 50,000, which is not because me and Ed are podcast geniuses. It is purely because people like you have listened to it and shared it. So we really appreciate that. But we want to do something that would be useful to our audience. So let us know in the comments what would be most useful to you, because I love the numbers, but for me personally, especially with my hand injury, just bumping into so many medical professionals who are helping me with my hand injury, and they say, oh, by the way, I really like your podcast. Like, that is worth more than any download. It feels incredible that we're helping our colleagues make better financial decisions. So thanks so much. Suggestions on what we should do. And let's get into this episode, shall we? Because even though we're nearly 1 million downloads on 180 episodes, we've never done capital gains tax. And it's so important to understand this tax because you're going to tell us why. So should we get into it?
Yeah, absolutely. Let's start and have a tiny bit of history / background to capital gains tax, although I'll keep it very brief. But basically, capital gains tax was introduced in the mid-1960s by the then Labour government. So it's actually one of the newer taxes, although it's still obviously fairly old. But it's brought in as a tax on the profits arising from the disposal of assets. Up until the 60s, there was no such thing. And a lot of people were using that unique benefit to try and avoid paying income tax, for example, by making things into capital gains tax, of which there was no tax. So the Labour government at the time decided to bring in this brand new capital gains tax. And it's becoming more and more important to the government as time goes on. So the data published by HMRC in August 2023, that showed that in the 2021 to 2022 tax year, 394,000 taxpayers paid capital gains tax, which is an increase of 20% on the previous year, and basically brought in £16.7 billion of revenue for the government. So not insignificant at all. And recently, capital gains tax has been in the news because the government has made some cuts to what is called the annual allowance to make some extra money. Taxpayers basically receive an annual allowance every tax year, and it's very similar to the personal allowance for income tax. So most of our listeners, if not all, will be aware of the personal allowance. So think of the annual allowance as just like that, but for capital gains tax. And it used to be that £12,300 of gains could be received capital gains tax free, but recently the government have cut that to £6,000 from the 6th of April 2023, and they intend to cut that again to £3,000 from the 6th of April 2024 as a way to help the government balance the books further. As per usual, we're not here to make you tax experts. Capital gains tax, just like all the other taxes, can get incredibly complicated. However, we thought today we would just go through some of the basics to once again help all you guys listening or watching to understand the taxes that you pay. Because if you don't understand it, there's a good chance you might pay too much. Okay, so you might wonder, when exactly does capital gains tax apply? Okay, so I'm going to use the definition, the jargon for a minute, and then I'll explain to you what it means. Okay, but capital gains tax, that applies if a chargeable person makes a chargeable disposal of a chargeable asset. Okay, now a chargeable person is basically an individual who is resident in the UK. All right, UK resident companies are also affected, but they pay corporation tax on any gains rather than capital gains tax. People that live overseas holding UK assets don't generally pay capital gains tax. Okay, so this is mainly UK resident individuals that pay the tax. Okay, we mentioned this term chargeable disposal. The most common form of chargeable disposals of an asset, of course, is a sale of an asset. But don't forget, or if you don't know this, you should definitely know this, gifts of an asset are also considered disposals. And even things like loss or destruction of an asset may count. And in this case, if you lose an asset, for example, if you have an asset that gets destroyed in a fire, that would often yield what's called a capital loss. So your proceeds are basically zero, but you have incurred a cost, so you make a capital loss. We should definitely mention this, okay? If any assets are transferred on death, then capital gains tax doesn't apply, okay? Inheritance tax comes into effect instead, okay? And I can't remember which number it is, but we've definitely done a podcast on inheritance tax not that long ago. So definitely go and check that out if you want to know more about inheritance tax. And then finally, so we're talking about chargeable persons, we talked about chargeable disposals. Finally, capital gains tax only applies to chargeable assets, okay? Because there are some assets out there that are not, that if you dispose of them, they will not result in a capital gains tax liability, okay? And it's really important to know about these, and I'm sure a lot of people will be very keen to know what these are, okay? So the following are included in this list, okay? I'm not going to pretend that every single thing, has been included here. Of course, it won't have done, but these are the key ones that you should know about, okay? So the first asset that you can dispose of and be exempt from capital gains tax is your principal private residence, okay? So if you own your own house, which you're currently living in, and you sell that house to someone, any profit you make on the sale of that house, your principal private residence, that should be free of any capital gains tax, okay? Which is obviously fantastic for those people who've bought houses. The house prices has increased since they bought it. They sell it for a profit. That is completely and utterly tax-free, okay? So that is very nice for those people to whom it applies, okay? Any shares that you hold in an ISA, those are also capital gains tax free, okay? So if you have an ISA, stocks and shares ISA, and shares within that are sold and they make a gain, you will not pay any capital gains tax. Another very commonly held asset, I think a lot of us will be holding this, and it's capital gains tax free, is cars, okay? If you have a car and you sell your car, there are no capital gains tax implications. Now, for the vast majority of cars, you're almost certainly going to make a loss when you sell your car. And that's exactly why, rather sneakily, these assets are exempt. Because if you make a capital loss, you can claim that loss. And I'll mention a bit more about losses in a bit. But if you make a loss on an asset, you can claim that loss. The government do not want every single person who ever sells a car to be able to claim a capital loss. Okay, so they automatically make cars exempt purely to make sure that we can't do that. Okay, so pretty sneaky, but that's what they do. Okay, government bonds or government gilts are also exempt from capital gains tax. So if you buy any treasury bonds, for example, and you make a gain on those, there will be no capital gains tax. Again, a little government rule there to try and encourage investment in buying up the government's debts. Any foreign currency that you hold for personal expenditure outside the UK, that also is exempt from capital gains tax. In that case, it just gets really complicated. So I recently went to Lisbon, went to Portugal. I got out some euros. If for some reason I made a gain when I converted those euros back to pounds, obviously it'd be a very small gain if I made one at all. The government, again, did not want the hassle of every single person going to every holiday, changing their currency back and forth and making a loss or a gain. So they've just completely exempted it to make things as easy as they can. Next, there's quite a decent list here. Next, if you hold any shares in what's called a venture capital trust. Now, fully appreciate this may not really apply to many of our listeners, but it might do. Any shares that you hold in a venture capital trust, if you sell them after a certain time frame, they should be exempt from capital gains tax. Okay, I think we did do a podcast all about venture capital trusts and other things on because we were asked about it. It's still a popular topic to get asked to do podcasts on, so it might be we need to resurrect that and do a refresher. But certainly, yeah, shares held in a venture capital trust, they are free of capital gains tax. Okay. All right, we're nearly at the end. It's actually quite longer list than I was thinking. So the next thing that you can get, the next thing that's exempt from capital gains tax are called wasting chattels. Okay, so a wasting chattel is a tangible, movable object. So that's what a chattel is. And when it's called a wasting chattel, it means it's got a predictable, useful life, not exceeding 50 years. Okay, so basically an object that you can see and move around with a lifespan that's predicted to be less than 50 years. Okay, so examples of a wasting chattel would include, and goodness knows who owns these, but racehorses and greyhounds, they're definitely wasting chattels. They're not going to last 50 years. But more importantly for us, computers, laptops, computers, if you were to, again, manage to sell those for a gain, there'll be no capital gains tax. Pieces of plant or machinery are also classified as wasting chattels as well. Okay, now you might think, well, this is getting really technical. What else is going on? Why does that apply to me? Basically, weirdly enough, HMRC consider clocks and watches as machinery for capital gains tax purposes. So if you were to be lucky enough to be in the possession of, say, a Rolex watch or an antique grandfather clock or anything like that, HMRC will consider those to be wasting chattels, have a life of less than 50 years, and therefore no capital gains tax will be payable if you then sold them. I'm just going to quickly touch, just because we're here, okay, I'm just going to quickly touch on the rules for non-wasting chattels. So again, tangible, movable property that's going to last for more than 50 years. So if you have any assets such as paintings, antiques, jewelry, etc., the rules are very complicated. I think you'd all go crazy if I went through the whole lot here. But basically, if the proceeds of sale that you receive on selling one of those items, if that's less than or equal to £6,000, then the resulting capital gain is completely exempt from capital gains tax. Okay, so those are just some examples. There are a few more which I didn't think were as important to mention, but those are just some key assets that if you dispose of them, no capital gains tax payable. So at this point, I just wanted to also mention, of course, that any transfers between spouses or civil partners, there's no capital gains tax or capital losses made on those transfers. Okay, so these basically take place of what's called a nil gain, nil loss transfer. So if, let's say I was married and I transferred some assets to my spouse, they would then hold the asset and they'll basically be deemed to have bought the asset at exactly the same time that I did, at exactly the same cost as I did. So there's no gain or loss. The transfer just goes to your spouse or civil partner exactly as if they were the ones that actually bought the asset. Okay. That's also the case if you give an asset to charity as well, by the way. If you were to donate assets to charity, give them away, there will be no capital gains tax for the charity. Okay, so there's quite a lot to take in there.
That was a super comprehensive list, but I thought it would be, and you alluded to some of this already, but like how this could work in practice. Because I remember when I first found out about how capital gains was taxed. The first time I found out about tax was literally when I got my first payslip as an F1. Then I looked at my debt repayments and everything like that, and I was just in a blind panic. And then I was just thinking, how am I going to buy a house? Because I just had, minus £85,000 of money, so really in debt. But the way that the capital gains is taxed way less, and you're about to talk about this, way less than income. So that primary principal private residence, right? Here's what I was thinking. I was thinking in 10 years' time, I might need a family home with, let's say, £50,000 as the deposit, right? To put down on a family home. Now, if I earned that money by working super hard as a doctor, doing locums and stuff, I would pay way more tax on it than if I, instead of going straight and buying a family home, no, not buying a house for 10 years and then buying a house in 10 years' time. Instead, what I did was, fortunately, my wife got a small inheritance, 20 grand, and we used that to buy a disgusting flat. It was disgusting, but we renovated that flat. And a few years later, we needed to move, so we sold it and we made a small profit on that. Okay. But because it's my primary principal private residence, easy for you to say, not for me. Because it's my principal private residence, I paid absolutely no tax on that extra money that I'd earned from selling my house. Whereas if I'd earned that money as a doctor, I would have paid a ton of tax and I would have paid my student loan contributions on it. It would have been terrible. And then I thought, okay, that worked quite well. So next house absolutely had no central heating. There was a patch in I'm going to call it a conservatory, but it wasn't really a conservatory. It was like a greenhouse off the back. There was a patch where it appeared that the former resident probably had passed away there on the carpet. It was really bad. No central heating for the winter. But guess what? We put some central heating in, renovated it. And then when it came to sell it, because we naturally needed to move house again, we sold it. And again, that money that we made on the house did not attract any tax at all. Whereas if I'd had to earn that money, it would have taken ages. So there are pros and cons to that. I lived in a house with no central heating, a stain on the carpet where the previous resident probably passed away, sadly. I, at one stage, had rats and mice. I thought it was either rats or mice, but apparently you can get both. They coexist if the house is enough of a hole. But the net result of that was that I have a house now. I have a house now, which I paid way less tax to get the deposit together than I would have if I'd earned that deposit being taxed as income. Does that make sense? Criticize my logic. And I know that we have differing views on houses because you like nice houses. I like doer-uppers, shall we say.
It's why I quite like new builds, or at least I have a new build, I guess is a better way to put it. And you really hope that a new build wouldn't start off with rats and mice and so on. But no, it does make sense. And capital gains tax, yeah, it swings around in terms of how it's charged, what the rates are, and so on. And you're absolutely right. At the moment, there is that disparity, isn't there, between what you pay on a capital gain versus what you pay on income tax. Income tax is definitely, for the majority of people, much higher than it is for capital gains tax. And we'll come into the rates in a minute for you guys who don't know what those are. But one thing I will say is that it used to be the case that the income tax rate and the capital gains tax rate were the same. So that wasn't even that long ago. So the 80s and 90s, they were basically very similar. The first, in the 80s and 90s used to pay 40% like you would do for income tax at that time, but you'd get some relief for inflation that's eroding the value of your asset. Then they got rid of that and brought in a way to reduce your capital gains tax rate based on how long you own the asset. Then they got rid of that and they made it into a flat rate. And that flat rate's gone up and down. There is a lot of speculation, a lot of talk that at some point they will equalize the capital gains tax rate and the income tax rate and make them exactly the same. That's always one of those kind of classic news stories that comes up all the time. That's what the government or the Labour Party are going to do. Who knows, really? It's speculation. But as you say, right now, yep, if you make a capital gain, then you're going to be paying less tax than you would do for. Plus, there are more exemptions, aren't there? You mentioned the principal private residence. Absolutely. There are people in London say, I've got a friend who had a flat in Sidcup and made a huge gain on that, and all entirely tax free because that was his principal private residence. So you're right. There is quite a disparity there, and capital gains usually are nicer when you can get them, but of course you have to have the asset in the first place, and then you've got to sell it, which you may or may not want to do. So but absolutely great point there.
It also explains why a lot of wealthy people might because I used to look at wealthy people buying like antique Ferraris for £1 million and just think, wow, what a waste of money. But actually, if they buy that antique Ferrari for £1 million and drive it around for 10 years, and in 10 years' time it's worth £2 million, because it's a car, they pay zero tax on that extra money. Is that right?
Yes, yeah, cars are exempt. So if you do buy an actual antique car, a valuable car, and you sell it for a profit, excellent work, zero tax for you. So yeah, I would never dream of buying such a thing, but if you do, yeah, no tax. I
Yeah,
think that's
same about
probably
watches as well.
yeah, that's the thing. Rolex watches, again, I don't have the money to buy one, but they're a really big thing now, aren't they? At the moment, there's I think Rolex are now stopping people from just buying them outright because the demand is so high. But yeah, if you then sell them on, again, no capital gains tax. So it's a pretty good point, good stage to actually explain what the rates of CGT are for those people who are listening right now and don't know what they are, because you'll see that there is that disparity with income tax we just mentioned. Because assuming that you make a gain on an eligible asset, so we've already gone through what's not eligible, but if you make a gain on an eligible asset in any tax year and that exceeds your annual allowance for that year, then you're going to pay capital gains tax. And the rate at which you pay basically depends on what type of taxpayer you are. If you're a higher or additional higher rate taxpayer, then you'll pay a 28% capital gains tax rate on gains from residential property. So remember, those are properties that aren't your principal private residence, the property you own and live in, and a 20% tax on capital gains from other chargeable assets. So shares or shares being basically the classic one, but other assets as well, jewelry, for example, etc. If you're a basic rate taxpayer, then your taxable gains, basically, if your taxable gains plus your taxable income, if they fall within the basic rate band, which hopefully a lot of people know is between £12,571 and £50,270, then the capital gains tax rate is 18% on residential property and 10% on other gains. So basically, it's 20% for additional higher or higher rate taxpayers and 10% for basic rate taxpayers, unless it's a second property or second or more property, in which case it's 20 and 18%. Okay, so you can see if I had shares which were worth lots of money and I sold them all for lots of money, made a huge gain, I would be paying 20% on that gain. Whereas, as Tommy said, if you're an additional high rate taxpayer, you're paying 45% income tax plus national insurance on your salary, plus pension contributions and student loan and all sorts. So quite a difference. There's also a whole extra capital gains tax rate, which I'm going to mention here, and that is if an individual owns and disposes of their own business, then there's also something called business asset disposal relief, which used to be called for many years, used to be called something called entrepreneurs relief. And that basically gives the owner a 10% capital gains tax rate on the first £1 million of gains if the rules are met. So usually, if you have basically a material shareholding in a company, which is usually defined as more than 5% of a company, then you should be eligible for business asset tape relief if you've held those shares for more than 2 years. And as I say, if you do that, so if you have your own business, for example, if you're in private practice with your own business and you sell that, having owned the shares for more than 2 years, then you're going to get a 10% tax rate up to £1 million of gains. Okay, so quite a significant chunk of your gain would be at 10%, if not all of it, in that situation. 10 million. So this would be the first £10 million of gains. If you owned your own company, you'd get a 10% tax rate, but that was reduced to 1 million not that long ago. But still pretty juicy, and say of particular interest for anyone who owns a business as part of, let's say, private practice. And that 10% rate applies no matter whether you're a basic rate, a higher rate, or an additional higher rate taxpayer. Okay, so whatever happens, if you have a material interest in a company, so more than 5% for more than 2 years, or, by the way, if you're a sole trader or a partner selling part or all of your business, again, as long as you have more than 5% of that business, then you're going to be paying a 10% tax rate on the first £1 million of gains. Okay, so fully appreciate this is not going to apply to lots and lots of people here. The vast majority of people, it's more just as let you know that exists. But yeah, I'm sure there will be some people out there with private practice businesses that might be able to benefit from that. Okay, so Just a couple of final points, okay? So I know I've talked quite a lot here, and hopefully you guys are still listening and still interested. But just some final points to note, okay? Any capital gains tax that's payable. So should you end up having to pay capital gains tax, any capital gains tax payable has to be paid by the 31st of January after the tax year in which the gain was made. If your total gains that you make are less than your tax-free annual allowance, so for example, if your, let's say your granddad left you some Tesco shares in an inheritance and you sell them and make a couple of £100 gain, which is below your tax-free annual allowance, you do not have to report the gains, okay? Unless the total amount you sell them for is more than 4 times the annual allowance, or you're already registered for self-assessment, okay? So just to reiterate, if you already do a tax return and you make a capital gain, put that on your tax return, okay? No matter what happens, you just put it on your tax return, okay? If you don't do a tax return already and you make a sale of an asset and that's below your tax-free annual allowance, you don't have to do anything. You don't have to do a tax return or tell HMRC unless the proceeds were more than 4 times the annual allowance, okay? So at the moment, the annual allowance is £6,000. So basically, if you sell something for more than £24,000, even if the gain is tiny, you sell it for £24,000 and the cost was £23,000, you still have to tell HMRC, okay? If you make a loss on disposal of an asset, you can make a claim for that loss, okay? So if you buy an asset and then many years later you're forced to sell it at a loss, you can claim that loss and then carry forward that loss against any future gains that you might make or any gains that you make in the same tax year if you have multiple assets that you sell. Okay. Again, if you do make a loss on an asset, you need to do a tax return to claim that loss. Otherwise, HMRC will have no idea that loss exists. Okay. I appreciate this is quite niche, but as I say, it's not going to be beyond the realms of possibility that people out there have bought some shares in a company. They have to sell them for whatever reason. Right now, the stock markets are down. They may make a loss on those shares. If you claim that loss, tell HMRC all about it. Then when you finally buy some shares and sell them at a profit, you can then use that loss you've made to lower your tax bill later on down the line, okay? We talked about what assets aren't capital gains tax. Just one thing to think about, any shares held in ISAs, we've mentioned this before, they are exempt from capital gains tax. And with the cuts in the annual allowance, that tax-free amount, that makes ISAs far more important than ever, okay, for shielding any capital gains that you make. So if you want to buy some shares in a specific company, doing so via an ISA will just shield any gains that might come about from any capital gains tax. Okay. It's becoming more and more important now. When the capital gains tax allowance or tax-free allowance was £12,300, that's great. But now it's 6,000, it's going to be 3,000 from next April. So the amount of gain you can make before you have to pay tax is getting lower and lower, which is going to catch more and more people, even people that you wouldn't dream of being caught by a capital gains tax in the future start to get caught by it. Okay, so just think about that. The other thing that people do regarding capital gains tax is, unlike, say, income tax, where you get your salary paid every month, or what else, inheritance tax, someone sadly passes away and you get given some money, which then might be chargeable to inheritance tax. Capital gains tax is an interesting one because to some extent, perhaps to quite a large extent, people have some say over when they dispose of their assets. Okay, so what some people can do, I'm not saying this is the vast majority, but some people, what they can do is they can time the disposal of their assets to try and utilize that tax-free annual allowance. Okay, so if, for example, I had some shares, I maybe that I could, and I wanted to get rid of them because I wanted the money for other reasons, I could sell some of the shares. If I know the value of the shares, each share, I could potentially dispose of some this year and make a gain of up to £6,000. And then next year, I could try and sell some more up to a gain of £3,000 to try and bring myself within that capital gains tax annual allowance. Okay, it's tricky. Okay, nothing is easy in this world, especially when it comes to tax. But if you have any scope over when you sell assets that you do want to sell, try and think about if there's a way to do it which covers is covered by your annual allowance to try and avoid paying some tax. I think I've said quite a lot now, so I'm gonna be quiet for a minute. Does that all make sense, Tommy?
Mate, these are my favorite type of podcasts because this is like a glimpse into your former life where you still are a chartered accountant and chartered tax advisor, but you are advising high net worth individuals. And you're right, a lot of this, Ferraris, watches, only really applies to your former clients when you were advising high net worth individuals. But there's so much for normal people as well that can be in there. Like just that tip there, that the capital gains annual allowance is dropping. Okay, so you need to take that into account if you've got anything to dispose of, and just make use of your ISA if you can. I love it. I guess we generally tend to stay classy on the podcast, so we just report the facts and we don't give our opinion on this. But this just seems crazy that there's such a differential tax rate between income that you earn and is subject to income tax and income that's taxed under capital gains. There's just a huge gap between. And I told you how I utilized that. It's not for everyone, but I don't know. Are we going to pass comment on that, or maybe think about could it make sense in a wider picture? Because I guess it's encouraging entrepreneurs in a way. I don't know. What do you think?
Yeah, different governments have got different views, haven't they, on what they want to encourage, what they like in society, in the economy. The general feeling amongst a lot of politicians certainly has been that they're trying to encourage shareholding. They're trying to encourage house owning. They're trying to encourage people setting up their own businesses and creating jobs and bringing in tax revenue. So I mentioned earlier that there's a thought that one day they may equalize the rates, capital gains tax and income tax. Could be an easy sell in one sense. They can say we need the money, and why should the richest who own the most assets profit from this? But equally, there'll be people out there that will say you're punishing entrepreneurs, you're punishing success, you're punishing people that want to try and invest their money in shares in British companies and so on and so forth. When they say that, when people speculate that one day those rates will be equalized, one thing they often say is, or again, it's just a viewpoint, just a thought of certain people, is that entrepreneurs relief, or business asset disposal relief as it's now clunkily called, that 10% rate for £1 million of gains for people that own their own business, there's a good chance that will remain, that will stay the same. Because if you imagine you're a Labour government and you say from now on everyone's paying 40% capital gains tax, then if you keep that 10% entrepreneurs relief, it's a little bit of a shield. You can say, but we are trying to protect our entrepreneurs who are creating companies and jobs and so on. So that it's thought that if they do that, entrepreneurs relief is likely to be safe, but who knows? There's definitely pros and cons I can see on both sides. I just also want to say one thing.
And
Sorry, mate. I don't know. I don't know if what this lag's coming from, but sorry, Scott. That just one thing I want to say, actually, Tommy, just to something I haven't mentioned at all about this podcast. So I just want to reiterate that capital gains tax is a UK-wide tax. Okay, so there's no differences between Northern Ireland, Scotland, Wales, and England. Okay, so it accounts for everyone. Everything I've said applies to everyone in the UK, which I probably should mention at the start, but just to say.
Yeah, really good caveat there, because as regular listeners will know, there are different income tax rates in Scotland, and I'm not going down that rabbit hole, but now we've done it a bit in the past. But I think, yeah, it's just such a wide differential. It seems a bit unusual, but I get now why wealthy people have Rolexes and buy cars, because worst case, you just offset it as a loss and move on, and best case, you make £1 million and don't pay any capital gains on it. And nice thing to be. Okay, cool. That was awesome, mate. If you're watching on YouTube and you want to ask us a question, pop it in the comments. If it's about Ferraris or expensive watches, that is something that me and Ed know nothing about because we don't have any of that. Is this a good time to do notice board? Because we are having a live event in London on the 9th of November, and it is just for advisors. Now, A, why are we having an event just for advisors? And B, why am I advertising that on this podcast? A lot of advisors listen to this podcast, and I think Medics Money has always been about helping doctors to get the best financial information that they can. And if you need help, we also have a network of the best advisors in the business. And we thought, if in medicine, if we've got a difficult case, we have a multidisciplinary team where all the experts get together. I usually have some mediocre coffee, which is always welcome in the NHS, and discuss it in detail. And so Medics Money Live on the 9th of November is like a MDT for advisors that specialize in doctors. So accountants are coming. Financial advisors are coming. We've got some lawyers coming. We've got some property experts coming. So if you are in that category and you are interested in improving the advice that you give to doctors, I'm going to say LinkedIn me or Andy Powell. Tickets are really going really well, but it's on the 9th of November. And it is just for advisors, not for doctors.
Nice. I was when you said notice board, I was like, what's this about? But yeah, no, that's a great thing to mention. Absolutely. So hopefully we'll see lots of people there.
Awesome.
Yeah, that's it.
Yeah.
But thanks for that, Tommy.
Yeah, thanks for listening. So if you're watching on YouTube, thanks for watching. If you've got any suggestions for comments or what we should do for our millionth download, which is actually going to be coming up. I haven't looked at the numbers recently, but I think it's coming up in like less than 2 months. So we need to actually go and actually talk about what we are going to do. But if you've got any suggestions, drop them in the comments. Don't forget to share this with your friends. If you've got any really wealthy friends, this podcast episode, this specific episode, probably quite useful for them. For the rest of us mere mortals, we can just dream of making a few quid on our house and not paying any tax on that, and maybe buying a watch that doesn't lose all of its value on day one. Brilliant. Thanks, mate. See you soon.
Cool. Thanks, mate. Bye.